So inheriting IRAs, you also have choices. So Pamela is 65 years old. Son is Kyle. He's 40. Pam dies and leaves 100% of the IRA to his son Kyle. IRA balance is 400, 6% rate of return. So Kyle takes distributions over 10 years to minimize tax. So this is something that the Secure Act changed. They giveth and they taketh. Remember, they changed the RMD age from 7.5 to 72. Well, they took away the ability to stretch this inheritance here, this IRA inheritance. They took away the ability to stretch this over Kyle's lifetime. Instead, Kyle has to take this out within 10 years. So it's a distribution of $54,000 a year on top of whatever Kyle makes. So it's going to cause some taxes to really accrue much quicker, and that's why it was done. So Kyle does nothing in years 1 through 9, takes full distribution in year 10. So this is a lot of money to take in year 10. A lot of it would go away to taxes. I will say this, if what Kyle inherited was a Roth IRA, definitely wait till year 10. Let the whole thing accumulate. Why? Well, it's growing tax deferred and it comes out tax free. So let the thing grow tax deferred for the full 10 years and then take it out. You'll be very happy. If it's an inherited IRA, that is a traditional IRA, not a Roth, I would say that you'd probably want to take a little out each year, although you're not obligated to. But I would say, equalize the distribution a little more to try to mitigate how much you're paying in income taxes. Taxes on long-term care. Well, premiums may be deductible at the federal and state level. Payments from policies for reimbursement of long-term care are tax-free. Choosing how to pay for long-term care can have a big impact on heirs. So let's look at this example. We have Florence, who's a widow. She qualifies for long-term care benefits. She has one of these hybrid long-term care policies where it's life insurance as well as a long-term care feature to it. She receives in-home care benefits of $60,000 a year, roughly $5,000 a month. That's not unusual. $20,000 a year in Social Security. She has $400,000 in an IRA. She has life insurance with a long-term care rider, $500,000 to the children upon her death, or up to $10,000 a month for long-term care. So the way these long-term care hybrid systems work is that they advance pay the $10,000 against the death benefit. So if they pay out, $50,000, well, now the $500,000 death benefit is $450,000. So you don't get something for nothing. What it's doing is that it's advancing the death benefit payment in order to use those dollars for care. So, what does she do, as far as what monies does she use for her care? Well, let's use the long-term care policy, because after all, that's what the policy was purchased for, to pay for the care, 5 years of care. So Florence pays little to no income tax during the last 5 years, high deductibles, high deductibles for unreimbursed medical expenses. So she's in a low tax bracket because of those high deductibles. Her long-term care insurance pays out $300,000 for in-home care, and the kids inherit the tax-free life policy of $200,000, as well as a $400,000 taxable IRA. So that's one way, and you would think that that would be the way to do it, because after all, you bought the long-term care, the hybrid long-term care policy for long-term care. But I'll just caution you, there is another way that it could have been done, which could have satisfied mom's coverage, but actually left more money to the heirs and more money to the kids. And I have to emphasize this, it's mom first, okay? All I'm sharing with you is that there's an alternative way to do this from a tax planning perspective that would have gotten mom the care she needed and would have actually preserved and given more assets to the kids, which I know mom would have enjoyed. She would have enjoyed that because it beat Uncle Sam. So Florence uses the IRA to pay for the care. Well, what's up with that, Kevin? Well, Listen, we said she has high medical expenses. So a lot of her income is being offset. So if she takes money out of the IRA, she's going to pay very little in tax on that money. And she's decreasing the IRA as opposed to the IRA being inherited by the family. And, if her kids are, well off, they're going to pay a lot more in tax on that inherited income than she will in her state currently. So uses IRA money to pay the $300,000. Kids inherit tax-free life insurance of $500,000, tax-free. Remember that 500 hybrid policy. That's a life insurance policy. So they get the $500,000 tax-free as a death benefit. And then they get the remaining $100,000 from the $400,000 IRA, and they'll pay tax on that. But the lion's share of the money, they won't owe any tax on. I think that's a much better way to do it. And again, use 300 taxable money versus 300 tax-free money. Goodness, how in the world do we manage this? Well, again, there are different phases of retirement. Depending on the phase you're in, I would bias these strategies. So pre-retirement, fund Roth accounts. Know your after-tax savings before retiring. Early retirement, understand how Social Security works and how the surcharges, the IRMA in Medicare works. Fill the buckets, when it's appropriate. If you're low in income in years, fill the buckets, because there's guys with PhD degrees who've done analysis on this and says that your nest egg will last longer. Middle retirement, manage your planned RMDs. Again, QCD should be in your future. If you're charitably inclined. If you're not charitably inclined, well, forget about them. But QCDs are a great way to go. All kidding aside. Late retirement. Well, organize your assets for the benefit of your family. Estate planning still matters. And, if you don't know what to do at this stage, well, then see somebody. See someone who has experience at this. I would recommend that strongly. Because your tax exposure changes throughout retirement, you need a tax strategy that anticipates how and when to tap assets, understands the range of taxes you'll face, and manages your actions so you pay the lowest possible. I've often told people that I think people spend more time planning their vacation than they do planning their retirement. And just with some steps and some plans to put in place, you could save a lot of money in this process, depending on what's going on with your family and what's happening. So there are strategies here that you can implement, and just spend a little time on it would really help. Preparing for retirement and taxes. So the distribution of monies, again, is much more complicated. The spending phase is much more complicated than the accumulation phase. I hope you're starting to see that. It's really very important. Managing taxes happens throughout retirement. It's not a one and done thing, because when you have a family life situation that changes things, you've got to change your plan. You got to adjust to it. If you make mistakes, it can be costly and not fixable. The IRS doesn't have much tolerance for whoopses. You can't do do-overs. And again, education, I think, is key to it. So as I said earlier, if you have a family member that you think may benefit, have them tune in here to the YouTube channel that we have. Have them use the information. Send it to them. Send them links. Please get the data out there. And request a tax a retirement overview meeting. I'd be very happy to do that. In fact, anyone who attends my presentations here and references it, I offer to meet with people on a consultative basis for 1 hour, and that's complimentary. And again, I would tell you what it might be best to bring in to do that, to have the best time available, the best advantage for you. I would tell you what to bring with you, but I would welcome that. I would welcome that. And again, if you'd like to have a meeting, please reach out to us. My email is info@westminsterwm.com, or you can call our offices at 908-904-4100. I hope you enjoyed the presentation. Thanks so much for joining us today, and have a great day. you.